All right, good afternoon, everyone, and welcome to the Morris Financial Concepts First Quarter 2016 Quarterly Market and Economic Review. This is Mario Nardone, and we'll be walking through the presentation today, probably in the course of the next half hour or so. This conference call is being recorded and will be available on the MFC website and upon request. So I do want to thank you for those of you that are here live and those of you checking it out later on. The purpose of these calls is really to educate and inform our client base and anyone who's interested in getting the perspective of Morris Financial Concepts about how we invest and why we do it that way, and then each quarter putting market news into perspective so that we can better digest our quarterly performance, so that we become better consumers of financial news and media, and maybe to ask more direct, astute questions than a regular investment quarterly report would otherwise inspire. So we do want to help you sift out the noise, but certainly things come up on a daily and weekly basis. So if there's something in the news that concerns you, we may not be addressing them all here on this call. So feel free to give your team at MFC a call or an email, and they'll be happy to either address your question or pass it along to me for a specific response. So on the first page, there is an overview of each of the slides we'll talk about through the course of the presentation, but I do want to call your attention to the left side of the screen, and that is really just to make sure that it's understood that this presentation isn't really meant to serve as an account review. This, we will make reference to the MFC strategy, but a lot of clients' portfolios are different because of the way MFC manages portfolios in a very customized kind of way. So we just want to take the information with a grain of salt. If you find that we're talking about something that doesn't pertain to you but want it specifically addressed, or if there's something we leave out that you have in your portfolio, maybe due to a legacy position, an inheritance, or some other type of strategy that you have, we'd be happy to address that in the context of the quarterly review as well. Just give us a shout, and we'll be happy to do that. So we are, a little bit removed from the first quarter, but sometimes, we realize we have to put a little bit of space between the quarter ends so that we can digest all the market news and have a chance to put together a cohesive presentation. So just keeping that in mind, this is a first quarter review. We understand the markets have moved since then, but again, it doesn't have to be up to the minute for it to be beneficial and informative. So just to review the first quarter, this particular slide is looking at major market segments. So we start off with the U.S. stock market. If you remember, early January was the worst start to a calendar year in the modern investment era. So the fact that we rebounded quite a bit throughout the course of the quarter was pretty positive news, and we ended up finishing about 1% to the positive here in the United States stock market. And now that's positive, but not great. I mean, if you think about it, a 1% quarterly performance translates to about a 4% annualized rate, and that's about half of what the average return has been since January 2001, and it's about half of what we estimate to be expected returns from the stock market in general, which is typically around 8%. Now let's turn our attention to international stocks, and when you see the word developed there, what we're talking about are developed markets, those that have mature stock markets, a lot of currency and banking regulation in place. So these are your old line countries like Canada, the UK, Japan, and Germany. And as you probably know, if you've been following the media and global economics, these countries have had a rough go of it lately. A lot of economic sluggishness, if you will, and we'll talk about that in a little bit of detail later on. Emerging markets, by contrast, are those economies that may be considered a little less mature. They don't necessarily have mature banking regulations or robust stock markets or even business regulation. So they tend to be considered a little more risky. Underlying them, they tend to be a little bit more commodities driven. Maybe they're less industrialized than the developed economies I mentioned earlier. And for that risk, investors have been compensated. So when you look at emerging market stocks looking positive and looking at their historical average quarterly return since January 2001, you do see that over that 15-year period, investors taking the risk of investing in emerging markets have been rewarded in a greater degree than even just investing here in the United States. So 2.9% average quarterly return versus 1.7%. But when you see the best and worst, you can get a sense of the volatility of investing in those markets. So we'll talk about that a little bit more as well. But nonetheless, a very positive first quarter coming off some pretty bad periods, and we'll look at that in a few slides. Global real estate, what we're referring to here are real estate investment trusts. These are professionally managed pools of real estate, be they apartment buildings, office buildings, self-storage facilities, medical facilities, things like that, that we can invest in because of their being traded on stock exchanges. So this is a very efficient way for Main Street investors to get exposure to diversified real estate holdings. And in this particular instance, global real estate has been a very strong performer. And if you recall, back in the fourth quarter of last year, they had done pretty well, also up about 5%. So it's been a good half of a year for global real estate positions. And then on the far right side of the page, we have U.S. and foreign bond markets exhibiting a little bit of a pop. And if you think back to what was happening in the first quarter, the Fed had kind of tapped the brakes on their commentary about raising interest rates. Remember that raising rates is typically bad for existing bonds. So in prior quarters, when the expectation was that interest rates were going to go up, there had been a little bit of pressure, downward selling pressure in the bond market. But with the Fed backing away from that change in policy, bonds exhibited a little bit of a pop or a spike upward in the first quarter. So that's a high-level overview. We're going to dive into a couple of these in a bit more detail. But first, let's look at some of the headlines that we read about in the news over the first quarter. And the way to read this chart is that this takes the MSCI All-Country World Index, which is a capitalization-weighted index of the entire global stock market. So it takes all the countries of the world stock market and weights them according to their market size. So it gives you a sense of how stocks did across the board in the first quarter, and it overlays some of the headlines. Now, I'm not going to talk about every one of them, but the biggest one that's on everybody's mind and seems to be a primary driver of the equity market is oil prices. So you saw in early January, oil skids to a 12-year low, and that was certainly at least a partial contributor to the bad start that equity markets had in the beginning part of this year. And then, as the quarter wore on, we started to see some positive news. Here, the U.S. budget deficit falls to its lowest level since August 2008. Now, that's pretty good news, and maybe that had something to do with the inflection point that got the market kicked off again, but it still was a pretty lackluster inflection point at that. So, sometimes we overemphasize the day-to-day market news, but in the long run, it's really where are we coming from? Where do we think we're going? How is the market interpreting this news? And that's what's going to ultimately drive changes in short-term stock prices. We believe in focusing on the long run, which we know is driven by earning potential for public stocks, public companies that in which we trade their stocks. So on the far right side, I just wanted to call your attention to this headline that says the U.S. dollar is on track for the worst quarter since 2010. One thing to keep in mind is that a falling dollar is good for our investments in foreign stocks. It sounds bad, right? It's not good for us as a consumer, but it may be a blessing in disguise when it comes to our investments in non-U.S. securities, and we'll talk about that later on. So this is a similar slide, but this shows the entire 12-month period ending March of 2016. So this is a one-year period, certainly not taking daily observations, but again, it puts everything into perspective with the overlay of the economic headlines. Now, not going to go into any detail on the headlines, but what I really wanted to point out is that if you stood there in March of 2016 and looked back at the path that the stock markets took, you would see quite a volatile period, right? And you might think back at what was happening over that period and remember volatility, maybe some nervousness, and quite a bit of ups and downs. But when you overlay that one period, or think about that period in the context of the longer-term history, you see that even that short-term volatility really constitutes a drop in the bucket relative to longer-term results and experiences. So we have to put that in perspective, that even though it felt kind of rocky, it really was kind of a benign environment relative to some other experiences that we've had. Now, if you were able to extend this chart and look back through the later half of the 1900s and back all the way to what's considered the modern investment era, going back to the Great Depression, you'll see that every single one of these blips is marginalized when you take it in a long-term perspective. So that's one of the jobs that we have as an advisor to help you realize, remember, and understand that even though day-to-day and month-to-month fluctuations may feel painful, in the long run, as long as you hang in there, we have continued faith that the stock market will provide returns going forward. So now we'll start diving into a little bit more detail on individual stock market performance and different investment categories in general. So the way this chart is organized is from top to bottom, best performers for the first quarter down to the worst performers for select market categories. So we talked about real estate investment trusts in one of the earlier slides. Basically what this is saying is that REITs that trade ex-US, or REITs that are domiciled outside the United States, were the best performing category on the page, returning about 8.6%. The next two best performers were two emerging markets categories, which obviously had also performed well during the period, but coming off pretty bad periods. Now, both of these categories may in fact be impacted by the perception of not only maybe expanding global economies, but also stabilization of oil prices. When you think about it, if oil prices stabilize, then companies and consumers can better plan out their capital expenditures. And as I mentioned earlier, emerging markets typically are very driven by the commodities that they produce, not necessarily industrialized economies yet. So they focus on producing natural resources. A lot of emerging markets economies are driven by oil. So there was a anticipation that the supply was going to be cut, which should have provided stabilization in oil prices during the first quarter, and that's potentially why these categories performed well. Now, on the flip side, the categories that underperformed, we're looking at small stocks here in the United States, which is represented by the Russell 2000 index, and as well as global stocks in general being underperformers. Diving more deeply into the U.S. equity markets, and again, I keep talking about the first quarter, and that's really because what we're trying to do is put the markets into perspective, and it's important to think about it in recent terms, although neither East Bay nor MFC invest based on short-term results or outlooks. It's just, again, to put things in perspective and explain the performance of our portfolios. So I sound like a broken record when I get to this slide every quarter, but we have to reiterate and remind you that two very important tenets of our investment strategy is to tilt our portfolios towards smaller companies and towards an investment strategy known as value investing. And this is essentially buying stocks trading at a discount to their book value. So when you think about small caps, we prefer small companies versus large, and we prefer value-oriented companies versus growth-oriented companies. And what you see on this chart is that investing in value, both in small companies and large companies, value outperformed growth, right? So small cap value significantly outperforming small cap growth, and large cap value significantly outperforming large cap growth. Unfortunately, when we look back over longer term periods, we're still in a period where growth investments have outperformed value over what we look at here as the long term, but we have some pretty substantial and convincing evidence over longer term periods of time that investing more heavily in value-oriented strategies tend to outperform and add value versus growth. So if you are interested in seeing that data over longer periods, please let us know, and we'll incorporate it into a future call or discuss it with you individually. Now, I know some folks are interested in knowing what is the outlook for the U.S. equity market. And again, we don't have a magic 8-ball or a crystal ball, and we don't get into the business of prognostication. But to put things in perspective, if you are attempting to do any sort of assessment of how the market should perform, then no exercise in that would be complete without looking at valuations relative to historic valuations. So what I mean by that is, where are stocks trading relative to their expected earnings? And I was collecting some data provided by JP Morgan that showed that a recent observation of the price to earnings ratio of the S&P 500 is about 16.6 times earnings. And what they do is they go back in history and they look at what's the 5-year performance record after periods in which the stock market is valued similarly. So they take every single possible PE ratio that's been observed, and they look at what the market's return was in the subsequent 5 years. So when you look at a PE ratio of about 16.6, the 5-year annual return following that period was 8%. And since that's the long-term average return of the market, the deduction there is that the rational deduction, if you will, is that the market is currently fairly valued. So it's not undervalued, it's not overvalued, it's not a screaming buy, it's not a screaming sell, at least when you look at the S&P 500. Now, what's important to note there is that even though you might say the expected return is 8%, the dispersion of observations goes everywhere from -3 to +15% on an annualized basis. So even though we might get a sense of where the markets are going, then once you start looking at the range of possibilities, it means, it makes us sit back and say, you know what, we're not going to make an investment decision based on that, because there's no way for us to know whether or not we'll get the average experience, the worst experience, or the best experience. So we try to take long-term, prudent approaches to investments and not try to time the market. Flipping over to international developed stocks, getting back into historically speaking in prior quarters, developed markets retrenched after a lot of investors kind of thought maybe in the fourth quarter this slide in international may have hit an inflection point. But one thing I want to do is kind of describe what we're looking at here, and you'll see that you'll see two numbers here for the returns for this category in the first quarter. And forget about value, large cap, and growth for now. Let's just focus on the dark gray and the light gray bars. And you'll see that they correspond to the light gray saying local currency, the dark gray being U.S. currency. And what that means is if you had been an investor in these foreign stocks and you yourself are domiciled in that country, then your investment return for this period, and let's look at value just as an example, your investment return in this category would have been minus 6.21%. But since we are U.S.-based investors, and essentially the way this hypothetical calculation works is that the assumption is that we trade in our dollars so that we can buy this foreign stock in its home currency, hold it for 3 months, and then hypothetically sell it and buy our dollars back. So when we say that the dollar weakened and that helped us as investors, you have to kind of go back and think about this in the context of if we were out of our dollars, we had traded in our dollars and instead held this foreign currency, and over that period the dollar declined, then now we are buying back those dollars at a decreased rate. So that's why we say if we're a dollar-based investor investing abroad and the dollar weakens, then that actually helps us as investors, and that's what's shown here on this chart. So it actually helped us from having an even poorer experience in our international stocks. Hopefully that wasn't too confusing. So looking at the bottom of the graph here, and this is where I wanted to get into a little bit more longer-term view, is that you see that these investment categories have really not performed very well in the intermediate to long term. And when we think about it, when you talk about Europe and all the troubles that they're going through, they're just now starting to realize that a lot of their central bank policies really didn't have the level of impact that our own stimulus package had here in the United States, and they're starting to revisit some of that. When you think about what was going on here in the 2008 era and even before that, we started to see the economy slowing down a little bit. And federal policy was, the quantitative easing, the lowering interest rates and things like that. So you see equity markets kind of getting a bounce from that over the last 3 or 10 years. But foreign countries, whether it's Japan or Italy or Greece, their policies. Hello?
Oh. Sorry,
their policy. Was there a question?
No, not yet.
Okay. Feel free to stop me. Sorry about that. But their policies really have not taken hold that way, and they're now starting to revisit and actually starting to model some of their revised policies and strategies after the ones that worked here in the United States. So we shall see. I'm not holding my breath, but we shall see, and we're not bailing on our international investment exposure based on past performance, and we're not necessarily counting on an immediate rebound. So now let's look at emerging market stocks, and I guess the only way to put it was that emerging markets seem to wake up a bit in the first quarter, but they're still in negative territory for the most recent 5 years, and again, very modest returns on an annualized basis going back 10 years. So one thing to keep in mind here is that emerging market stocks only constitute 10% of the global market. Our investment strategies have even less than that allocated to emerging markets. So once you factor in the probability that you have some portion of your account in bonds and only a small portion of your stocks are in emerging markets, you really don't have that much exposure, although even a little bit of exposure provides strong diversification and potential higher returns over the long term. So we are sticking with that strategy as well. We don't really focus on country results, but at least one point to make, and it ties into an earlier comment, and that is the recent strong performance of Canada. Just like my comments on emerging markets, Canada's stock market is driven very much by the oil industry, oil and gas. So during the first quarter, there was that perception that oil price stabilization might have been in our midst. So Canada experienced about a 12% gain. Now, we have to put that in perspective and remember that that's coming off of a 43% slide, peak to trough, for Canada, dating from September of 2014 to January of 2016. So Canada's stock market had suffered greatly, and you know that when you're coming off of a low base, then even a small pop looks like a pretty strong magnitude. So you do have to take these kinds of statistics with a grain of salt. Now, on the other side, I mentioned Italy and Greece. These countries still kind of pulling up the rear in terms of European stock markets, both Italy on the developed market side and Greece on the emerging market side. Diving into real estate investment trusts, again, just for definition, these are professionally managed pools or portfolios of commercial real estate, and they trade on stock markets just like stocks do. So it gives us liquid access to these categories. So let's just compare and contrast the most recent period of U.S. REITs versus non-U.S. REITs. And this really does tie into the economic fortunes of each of these countries. When you think about a growing economy, what tends to happen? Apartment buildings get filled up. Office buildings get filled up. There's generally more economic activity, and that directly translates into the rents that are received by these real estate management companies, and that in turn improves the value of those securities. So when we look at the U.S. versus global, it's no surprise that U.S. REITs have performed better than global REITs over this period where we're saying the global economies have been sluggish. We don't have many direct investments into commodities. We enjoy the conversation, and some folks may employ them in their specific strategies. So I don't want to go into too much detail here, but the fact that gold was the #1 performer in the first quarter definitely generates some interest, some questions, and some media attention. So what we have to remember is that gold had been on a multi-year slide. So again, coming off a low base, this isn't really that big of a deal, even though it says 16% relative to other types of investment asset returns. But what I think is even more important is a theme and a philosophy or belief that we've shared time and again, and that is that gold has traditionally been viewed as a store of wealth. It's traditionally been used as a defensive holding when the expectation is that other types of assets might feel or become under pressure. But what we have to realize and think about in that investment strategy is the fact that gold really does not have any practical use. There's no practical application that says, if the world, goes into some sort of a crisis, we can't eat gold, we can't plant it, turn it into something. It has very little industrial use. So the fact that gold has been of value in the past doesn't necessarily mean that it always will. So we don't put too much stock in that, no pun intended, we don't put too much emphasis in that belief that gold will always be a defensive and high confidence store of value. Now, we're happy to have that conversation. But that's just kind of the general belief structure, right, that we follow. So turning our attention to bonds, bonds get one slide in this presentation, although if you pick up the Wall Street Journal or even just if you think about the amount of commentary that the bond market has generated in the investment space recently, that one slide isn't really doing it justice. But it is a busy slide. So what I want to focus on is the very middle section that's labeled U.S. Treasury Yield Curve. And all I want to do is remind you that what a yield curve is, and this is 3 yield curves, just one at each of 3 different dates in time. But what a yield curve is it tells you what bonds of various maturities are paying in terms of their interest rate. So if you invest in a very short-term U.S. Treasury bill, you're going to get very little or no return. If you extend your holding period and buy a 5-year bond or a 10-year bond or a 30-year bond, you're getting some rate of return back from the U.S. government, but not much. Now, if you think about this yield curve in a historical context, the short end of the curve has typically paid between 3 and 3.5%, and it goes up from there. And that has even been able to help you outpace inflation to a degree. But with these very historically low interest rates, you can't just focus on conservative bond positions anymore. So one of the things that the MFC team and I spend a lot of time on is how do we invest the bond side of our clients' portfolios? Because just like with timing the stock market, we don't think that we should be out of the bond market. We think it provides stabilization and diversification in a portfolio. But that said, we don't just want to be out there taking the low returns that Treasury bonds are giving us. So if you look to the right, you see that the 10-year U.S. Treasury is paying 1.78%. So that puts it somewhere around here, right? But what we could do is look at other types of categories. So for IRAs and other tax-deferred accounts, we can sprinkle in some corporate bonds. We might want to go a little bit lower on the credit scale, and that gives us a much better rate of return, another 1.5% a year potential rate of return. And yes, there is a little bit more default risk, but the statistics say that as long as we're investing in a diversified manner, we can put up with those fractional percentage point default rates and collect our better rate of return. So it's our job to monitor your bond portfolio and make sure you have the appropriate mix of treasuries, corporate bonds, as well as bonds that are issued outside the United States. In your taxable accounts, and especially for those of you in high tax brackets, you'll start seeing municipal bonds sprinkled in. And this is a very interesting period because municipal bonds alone have been yielding at or better than some of their taxable bond counterparts. So when you think about the fact that your muni income is not going to be taxed at the federal level, they become a much more attractive value, an attractive option relative to other types of bonds in the market.
Mario, this
Yes.
is Ann. Can you hear me?
I can hear you.
Good. I apologize. I didn't realize I'm on my iPad and I've never done it, so I didn't know how to mute the mic earlier. My question is about the local municipals and how you, with some of them going into bankruptcy, how do you sort of stay ahead of that curve?
So one thing that is probably worth noting is that we very infrequently use individual bonds in these strategies. So our preference is to use diversified mutual funds of muni bonds, and specifically higher quality bonds. So if we have a portfolio that holds 4,000 individual bonds, even if one bond or one issuer goes into default, that's not even really going to register as a blip on the radar. When we evaluate individual bonds, we want to look at things like, obviously, their own credit worthiness, but then we would look at whether or not there was bond insurance, or if those, and these are very technical terms, but we would tend to prefer buying a bond that whose interest and principal had been insured by a third party, or those that have been pre-refunded. So the issuing municipality essentially has insulated its investors against the risk of default. If you wanted to, we can talk offline if you have a very specific case in mind. But in general, whether it's stocks, bonds, or what have you, we tend to prefer diversified portfolios rather than trying to identify an individual bond.
Great, thanks.
Does that answer? If you have a specific issuer in mind, let's follow up with that after the meeting. Okay.
Yeah.
So, just putting it all into context, right? This final slide that really just shows you various combinations of conservative investments, that being treasuries, and risky investments, that being stocks, and combinations in between. What we have to kind of realize is that would we all like to achieve our goals and not have to take any risk? Yes. So if that were possible, and if Treasury bills provided a rate of return that helped us meet our goals, then that's where everybody would be, right? So, but if you look back over 10 years, if we were in very conservative investments, our rate of return would have been about 1%. Over that period of time, while inflation has been benign versus longer-term experience, it's still been about 2.5%. So that leads us to have to realize we need to take risk in our portfolio, and that doesn't even factor in whether we're spending from that account. So just to keep pace with inflation, what this chart is telling you is that over that period of time, we had to have at least 25% of our portfolio in stocks just to keep pace with inflation. And then based on our goals and how much we feel like we need to spend from our portfolio, how much we want it to grow, what our ultimate objectives might be, that's how and why the team at MFC spends so much time working on your financial plan to try to figure out what are your goals, what are your needs, and how do we balance those against your desire and ability to withstand fluctuations. Because if you look at this chart, you see that over the same period as on the left, taking the risk of going from 100% treasuries to 100% stocks really only got you about 3.5% extra per year, yet you had to withstand, I'm sorry, it's not the 10-year period, but if we just cut this down, you still have to withstand much greater fluctuations in value just to achieve that incremental return. So it's our job to figure out how much you can withstand, and then when those periods materialize, to help you maintain composure, put it all in perspective, and not lose faith in the system that we're relying on and investing in for the long term. So that's really the end of my prepared slides and statements, but I'd be happy to open it up to any additional questions that you have today. And with that, I am going to turn the recording off, but happy to stay on the line as long as possible.